Hi, everyone. I'm Steve Dietz, and I'm here with Greyson Geiler. We are the co-founders of Andorra Capital and co-managers of Goldrush Yield Fund. Our strategy utilizes gold and silver denominated leases and bonds designed to generate yield that is actually paid in metal. Because this is still an evolving and somewhat unique area of the market, we are putting together a series of short Q&A discussions around the questions we hear most often, from how these markets work to how a strategy like this may fit inside a diversified portfolio, and why we take a long-term view on things. Feel free to leave questions in the comments below, and we'll try to work them into future discussions. So, hey, Grayson,
Hey,
one of the things that I want to dive into today is, we talk a lot about how what we're witnessing is a renaissance in gold or an evolution of the gold market. Can you do a bit of a deep dive today on what changed in the precious metals markets and what made this strategy possible today? This whole idea of receiving a yield paid in metal is so foreign to so many people that
yeah,
I think it would do people some good to hear it from the ground up, I guess.
sure. Well, understand that gold is money and it always has been. Silver is money, it always has been. So a lot of people that this doesn't seem intuitive to, some of that's simply because the last 60, 70 years, whatever the math is, the only window of human history where gold and silver haven't been quickly or mostly regarded as money. But understand, even in a dollar denominated world, there's still a natural interest rate to gold, right? If you have a stack of gold and it's just an investment asset for you, you don't have any particular, you're not clinging to it. Plenty of businesses will pay you a gold interest rate to use your gold. The reason for that is because they either use gold in their business, which is obviously really expensive, or they're mines and they're going to produce more gold. So they want to even up their assets and their liabilities, or their coming income in gold, if they're miners, match it up to their liability, what they would owe the people that gave them capital to get their gold mine running. It's a lot easier if that's gold. You wouldn't go buy a new house denominated in Japanese yen, would you?
Right.
I mean, actually, you'd probably be lucky because the yen's going to keep devaluing versus the dollar. But you've got price risk. Your income is in US dollars. Your liabilities in yen. Wow, that doesn't make sense. Let's match them up. So that's always been out there, right? But you're asking what's changing the marketplace. A lot of it's simply the dollar value of gold and silver make them more monetary instruments. Look at it from this perspective. Nobody's completely honest about how much gold they have, right? So how much gold is there on the whole planet is a guess. A lot of people have been tracking production for so long that they've got a better guess than most of the rest of us. So let's just say between gold and silver, you're talking about $40 trillion of asset. $40 trillion, most of it sitting idle. Well, I mean, even rewind 5 years ago, that was only 15. So some of what's changed is simply the dollar value of the gold and silver that's sitting in people's basements, closets. It's more of a, wait a second, this is a lot of money. Can I get an interest rate on it? So the other thing I would tell you is gold and silver, well, central banks mostly with gold, bullion banks mostly with gold, they've been leasing and loaning their metal out for decades. There's always been a lease rate for gold coming out of bullion banks, central banks. Opaque contracts, but that's a whole different discussion. Didn't really know what they were. But these are people with gold trying to get an interest rate on gold, leasing and lending out to businesses that had use for gold. So that part isn't new either. The real or close to new part is now there's a standardized public, not publicly traded, as far as the equity of, but a transparent marketplace of gold lenders and gold borrowers, gold lessors and lessees, public marketplace where they're coming together. So the contracts are standardized, they're transparent rather than opaque. There's a lot of insurance and structure and safeguards around the whole thing. So it's really facilitating. Hey, if you've been sitting with gold sitting in your basement, guess what? It's worth a lot more money now than when you bought it. And you don't have to sell it. You can just deposit it, get an interest rate on it. I hope that helps.
Yep, it sure does. And so talk about then the types of businesses that are getting involved in this, and is it heavier to the leases, to the bonds? How's
Well,
that
let's
all
talk just
together?
really briefly. Leases and bonds are two different financial instruments, right? A lease is when you have property that you're not using and somebody else is going to pay you to use your property. You still own the property, just like if you have an extra house that you're renting out. That's a lease. There's a lot less risk in a lease because you're maintaining ownership. And if the counterparty's not making good on it, you kick them out of the house or take your gold back, and kick them to the curb. So a bond's a different animal. And the bonds that are denominated in lease in gold and silver that we're talking about, really no different from the corporate bonds that you buy through your Schwab account. You're lending assets to a business, the money's gone. You lend Coca-Cola $1 million, the money's gone. They've just built a new Coca-Cola plant in Mexico, probably, right? But the money's gone. You've just done the homework, or you've got a broker, agent, financial advisor, whoever, who's done the diligence to make sure you're going to get paid back with an interest rate. Well, it's the same thing with these the bonds, denominated in gold and silver. It's almost exclusively to mining companies. So we'll lend them in a bond, gold and silver. That gold and silver is gone. They sold it for US dollars, and they bought trucks, paid payroll, bought drills, water piping, all this kind of stuff that mining companies do. The gold is gone. We just, as fiduciaries, have to make sure we've done our due diligence to make sure we're going to get gold back and a gold interest rate. And again, the mining companies, their income is denominated in ounces, so they certainly would like to have their liabilities denominated in ounces so they don't have any price risk. Hey, gold $4,600 an ounce. If that goes to $3,500, a mining company's income just got shaved in a quarter. A quarter of it just got shaved off. It's gone. Did they hedge it through a futures contract? Well, that's a whole nother animal. So that's really the driving force. Especially on the bond side, I've explained who's going to be borrowing in gold terms, but now you want to know who's going to lease gold. Because I think we get it. If you don't have enough capital to buy a house, but you need some place to live, you're going to rent. Well, as expensive as gold has gotten, imagine being a jewelry company. Imagine being a bullion company, just selling ounces to investors, right? Your inventory is really expensive now. And as you buy more and have more in inventory, now you've got price risk, just like I described. If it's your asset and the price of it gets shaved by 25%, you just took a big hit. So why wouldn't we use someone else's gold? If we're simply a bullion dealer, you realize Costco sold almost 1 million ounces of gold last year? Just retail, just people going into Costco. Oh, let's buy some gold. They sold almost 1 million ounces of gold.
I know, it's wild.
Well, here's a hypothetical for you. What if you were the purchasing manager of Costco, and coming into 2026, you said, well, we sold almost 1 million ounces of gold last year. I have to go buy 1 million ounces of gold to distribute between the Costco stores. That's a $5 billion capital outlay. It's a lot of capital. They probably want to open more stores rather than that, rather than buy gold with it. That's heavy inventory cost. But now they also have a price risk, because there's a secondary market that tells them what the gold that they just bought to sell to their customers is worth. Let me give an example. Let's say Costco just bought 5 billion ounces of gold, and that's their inventory. Let's say Costco just bought 1 billion ounces worth of blue jeans. Well, there's no secondary blue jean market. So no customers coming into Costco, oh, hey, the blue jean market just got wailed on last week. No way I'm paying that price. You guys got to lower it. And all that inventory in blue jeans, Costco just lost a ton of money. That's not how the world works, but that's exactly how it works in gold. So if Costco buys all this gold to sell to their customers and the price of gold takes a hit, Costco just lost a lot of money, because nobody's going to come in and pay 20%. Nobody's going to come into Costco and pay $5,500 an ounce where gold was in January, just because they feel bad because that's what Costco paid for it. They don't care. So in this hypothetical, Costco could just lease gold from us. It's our gold on account at Costco. And as they're selling, they're buying more. So it's kind of a conveyor belt of gold. They make their 5% every time they sell some. They use the principal proceeds to buy more gold and put it on the conveyor belt. The entire time, it's our gold. Costco doesn't have the capital outlay. Costco doesn't have the price risk. We do. That's okay. They're paying us at 5%, whatever the interest rate is. 4, 5, 6, 2, whatever the interest rate is, they're paying that to use our gold. So that flows through for a lot of companies. A lot of companies will have gold on account in inventory, and they just don't like the price risk anymore. So they're going to keep our gold in inventory and pay us an interest rate to use it. If you go to a car dealership, all those cars on the lot, the car dealership does not own those cars. They're leasing those from the car manufacturer. Same thing. Jewelry store. The jewelry is a lot different around the globe than it is here in America.
Right. Expand on that. We're not talking about K Jewelers down at your
No,
local mall, right?
no, but I mean, understand, all over the East, and I'm talking about India, I'm talking about Dubai, UAE, Abu Dhabi, Bangkok, Malaysia, all these places. They've never really trusted their banks. They've always had currency problems. They don't have the sophisticated capital markets that we have as Americans to invest in. They don't have an SPY, a ticker for the ETF of the S&P 500. They don't. I mean, to a lot of people in the East, investing is just buying more gold or buying more jewelry. So there are lots of opportunities all around the globe, especially in Dubai, that's become the world center of gold, to, hey, somebody wants to use your gold and they'll pay an interest rate in gold to do it. I hope that helps.
Yes, absolutely. This is kind of staying in the same vein as we come on our 1 year anniversary for the fund here in June. I think it would be interesting to talk a little bit about how, while we're just 1 year into it, you've been deeply involved with leases and bonds for what, 6, 7 years, something like that.
Yeah. So this private marketplace that I've been talking about, privately held marketplace, I should say, but transparent, bringing the leaseors and lessees and lenders and borrowers together for gold and silver terms. This marketplace has been running for better than a decade now, very successfully, very high growth rate. And again, it's transparent. There's a lot of insurance up and down in a lot of these contracts. It's standardized. You can see what's going on. You can log into your account, see how many ounces of gold you have. Always a dollar calculation because people can't get away from thinking in US dollar terms. So yeah, it's that I've been doing this for the better part of a decade now, and it's only getting better, and there's more opportunity all the time
That's what I was going to ask.
as
Like,
the
how have you,
marketplace develops. Yeah.
how have you seen it evolve and the types of players that have come into it and
Yeah. I mean, our fund and the StoneX is a huge multinational, it's a Fortune 100 company. If you're not in the commodity market, you may not be that familiar with StoneX, but our fund is leasing silver to StoneX, just as a line of credit in commodity terms, because they move so many commodities all over the globe that it's just easier for them to have a line of credit in silver terms. Silver, especially, is a commodity that there's some wild challenges moving the actual physical of silver. So silver's back in the monetary system. It's back as a monetary asset. So that's a great example. A big company like that coming into what we're doing. We've got some big name mining companies have to remain unnamed for now, but there are some big retailers that every American will recognize their name are really coming into this marketplace. And again, lots of reasons for it. I didn't break it down on a 1, 2, 3 that well, but we've talked about it. The price of gold and silver is so much higher. Fear of people going away from the dollar is so much higher. Kind of mandating on America's kind of mandated on the Russians to use gold. We told them they couldn't play in the US dollar sandbox anymore. So there are a lot of factors coming together, and our fund is on the cutting edge of really taking advantage of the opportunities that are presented to us.
and so kind of building off of that, I have my own answer to this question, but I want to hear your answer to this is, at what point in time in this whole process, did you realize that this was becoming a real market, not just some tiny niche?
Yeah, well, that's an interesting question too, because it definitely felt like a tiny niche during COVID, because it was so hard to get people to commit to a lot of things during COVID. But really in front of COVID, I anticipated this, in front of us launching the fund, getting started putting the fund together, I guess, is really when I realized that this was going to be more than a niche. So call it 2.5 years ago.
Okay. I think for me, what really raised my eyebrows was when the bond got put together for Okobo, which is
Yep.
a publicly traded company in Europe, and
Yep.
and a bond was put together to fully finance a mining operation in Ethiopia. I was like, whoa, this is getting institutional in a hurry.
That's a good point. Yeah, and we did a silver bond to another publicly traded company, Bunker Hill. That's no joke either. And with the dollar value of silver going so much higher, that's a lot of capital getting moved around in silver terms
Right.
rather than US dollars. Yeah.
And so I mean I know your answer to this, but I think it deserves being talked about. I mean, obviously, we still think we're early in the whole development of this marketplace. Can you talk a little bit about how, why you think we're still, we talk about like maybe just in the second inning?
Yeah, and that obvious, and again, the world has reawakened to gold maintains your purchasing power, and I mean, we mandated that to the Russians, the Chinese, and the Indians are really mandating this on the rest of the globe. I mean, new gold depositories are getting built all over the globe. So people are even starting to speak in terms of ounces rather than dollars. So it's pretty obvious actually that the trend is in motion. It's set, it's going. But then it's especially American financiers. America looks at gold differently than the rest of the world because we've had the call it luck, call it positioning, call it whatever you want, but we've got the world's reserve currency. So understanding and viewing the world from a gold perspective hasn't been as necessary for Americans. And so when you talk to Americans about it, it'll take them a while to really catch on to what's going. But it's going to continue. Yeah, I'd call it the second inning.
Yeah, I mean, I find it interesting getting into conversations with people about this stuff that they just don't realize how deep and high velocity and liquid the gold market and silver
Yeah.
markets are on a world scale. I mean, it is a truly liquid, I don't want to call it interbanking, but
Oh,
it intervaulting system.
if you need to move capital, you've got the S&P 500 because there's so many derivatives and so many different marketplaces that use the S&P 500. You've got gold and you've got U.S. Treasuries. And crazy part about that is the long end of the U.S. Treasury curve isn't that liquid anymore. So they're bringing all the volume to the front end of the U.S. Treasury curve. That's as liquid as anything, of course.
Right.
But yeah, gold is right up there with the S&P 500 as far as the most liquid investment vehicles on the globe. You can move a ton of capital, and the market barely budges. So
Right.
yeah.
All right. I think with that, we should wrap up this Q&A.
Okay.
Good discussion there. And again, if anybody has questions either about this discussion or something else they want us to talk about later on down the line, please put them in the comments below.
All right. Thanks, Steve.
See you,
Talk to you
Grayson.
soon.